Good afternoon, everybody. Welcome to the first MPC meeting of 2014. And I'm sure, just as we are, aware that the first month is already almost over, so it is off to a cracking start. But you're most welcome. Since the previous meeting of the Monetary Policy Committee, the expected cutback in quantitative easing by the US has begun. Although the initial response in global financial markets was generally fairly muted, emerging markets have subsequently experienced a high degree of turbulence, particularly in the wake of renewed fears of a slowdown in China. While the Fed action signals a recovery in the US and the UK economic outlook is also improving, it does not mean that the global financial crisis is over. Rather, we are now entering a phase of the crisis that is creating new challenges for emerging market economies. In the longer run, a sustained recovery in the US should be positive for the global economy in general, but the adjustment to the withdrawal of quantitative easing is likely to create significant short to medium-term challenges. How to respond to a combination of sharply depreciating currencies, capital outflows, slowing growth, rising inflation, significant current account and/or fiscal deficits, and deteriorating confidence is posing policy challenges and very difficult trade-offs for many emerging markets. The Rand exchange rate has been one of the currencies affected by these developments, and the recent depreciation of the Rand, if sustained, will raise significantly the risk to the inflation outlook. Our inflation forecast shows a marked deterioration, despite the absence of clear evidence of domestic demand pressures. The recent inflation data reflects positive outcomes that belie the incipient risks, largely from the depreciation of the currency, that our forecasts highlight. The year-on-year inflation rate, as measured by the Consumer Price Index for all urban areas, measured 5.3% in November 2013 and 5.4% in December, resulting in an average annual inflation rate of 5.7% for 2013. Food and non-alcoholic beverage price inflation continued to moderate from a recent peak of 7.1% in August to 3.8% in November and 3.5% in December. The contribution of this category to the average CPI increase was 0.5 percentage points in December, compared to 0.6 percentage points in the previous month. The petrol price, which was the main contributor to the higher overall inflation in December, increased at a year-on-year rate of 10%, up from 7.7% in November. Core inflation, which excludes food, petrol, and electricity, has been unchanged at 5.3% for the 4 months to December, while administered price inflation, excluding petrol, measured 6.8%. The headline producer price inflation for final manufactured goods measured 5.8% in November, compared to 6.3% in October. The headline inflation forecast of the bank has deteriorated since the previous meeting of the MPC, mainly as a result of revisions to the assumptions regarding the Rand exchange rate. The forecast average inflation rate for 2014 is 0.6 percentage points higher at 6.3% and 0.6 percentage points higher at 0.6% in 2015 as well, with inflation expected to average 5.9% in the final quarter of that year. Inflation is expected to breach the upper end of the target range in the second quarter of 2014 and to reach a peak of 6.6% in the final quarter of the year, before declining to 6% in the second quarter of 2015. Core inflation, which averaged 5.2% in 2013, is expected to average 5.8% in 2014, compared with 5.6% in the previous forecast, while the forecast for 2015 has increased from 5.3% to 5.9%. The deterioration in this measure of underlying inflation continues to be driven primarily by the lagged effects of the depreciation of the Rand exchange rate. Inflation expectations appear to have remained relatively anchored at the upper end of the target. According to the survey conducted in the fourth quarter of 2013 by the Bureau for Economic Research at Stellenbosch University, average inflation expectations of respondents measured 6.1% for both 2014 and 2015 and have remained more or less unchanged since 2011. There is, however, some divergence between the average expectations of respondents, which range between 5.6% and 6.4% in 2014, and 5.5% and 6.5% in 2015. Financial analysts have the lowest forecasts, which are also reflected in the latest Reuters survey that indicates expectations of 5.6% and 5.5% for 2014 and 15 respectively. While the economic growth outlook for a number of emerging market economies has deteriorated somewhat in recent months, the prospects in the advanced economies have improved, particularly in the United States and the United Kingdom. However, the recovery remains uneven and not without risks. In the US, growth is being driven by a recovery in the housing market, robust private sector demand, and a dissipation of the negative impulse from fiscal consolidation. In its latest World Economic Outlook update, the IMF forecasts growth of 2.8% in 2014 for the US, compared with 1.9% in 2013. The outlook for the Eurozone remains fragile and uneven, particularly in the southern periphery, where the risk of deflation, strong fiscal consolidation, and weak banking sectors are constraining the recovery. Eurozone growth in 2014 is expected to remain subdued at around 1%. The Japanese economy has maintained its positive growth, but there are still doubts about its sustainability in the absence of continued fiscal stimulus. The outlook for the Chinese economy is increasingly uncertain, given the challenge of containing the excessive increase in credit extension without adversely impacting on growth. Although a growth rate of around 7.5% is still generally expected, the latest PMI, which suggests a contraction of industrial production, indicates some downside risk to this outlook. This uncertainty has contributed to increased risk aversion and volatility in financial markets of emerging economies in recent weeks, and is also likely to impact negatively on commodity prices. Significant currency depreciation and weaker growth prospects are also evident in a number of other large emerging economies, particularly Brazil, Russia, and Turkey, while the outlook for the Indian economy appears to have improved somewhat. Global inflation remains benign despite abundant liquidity. However, spillover effects from increasingly divergent monetary policies are creating a difficult and volatile environment for emerging markets. There is still some uncertainty regarding the pace of tapering by the Fed in the coming months, and although market expectations are that the US policy rate is unlikely to increase before at least mid-2015, long-term bond yields have increased to around 2.8% from around 1.6% in May 2013. A further sustained improvement in UK growth and employment trends has brought forward the prospect of monetary tightening by the Bank of England. However, monetary policy is expected to remain highly accommodative in Japan and the Eurozone, where the risk of deflation persists. The expectation of tapering by the Fed since May 2013 resulted in significant outflows from emerging economies' domestic bond and equity markets, putting pressure on exchange rates and long-term bond yields, particularly in those countries with sizable current account deficits. Some countries, including Brazil, Turkey, Indonesia, and India, responded by tightening monetary policy, either in reaction to inflationary pressures or in an attempt to stem the depreciation. Since May 2013, cumulative interest rate increases have amounted to 300 basis points in Brazil and 75 basis points in India. The most recent instance has been Turkey, which raised its overnight interest rates, the MFR, by 425 basis points to 12%. The impact of these developments on the Rand exchange rate has resulted in a marked increase in the upside risk to the inflation forecast, despite the relatively muted pass-through to date. Since the previous MPC meeting, the Rand has depreciated by about 7.4% against the US dollar, 9% against the euro, and 8% on a trade-weighted basis. Year to date, the Rand-dollar depreciation has been about 3.5%. In the final 2 months of 2013, total net sales by non-residents of South African domestic government bonds and equities amounted to 21 billion and 19.4 billion respectively. These flows effectively reversed the inflows that occurred during the earlier part of the year, with net purchases of bond and equities for 2013 by non-residents amounting to 1.3 billion compared with 85.2 billion for 2012. Year-to-date, net sales of equities and bonds have totaled 19.3 billion, of which 15.6 billion were bonds. While the recent Rand weakness is part of a general emerging market phenomenon, it has been reinforced by idiosyncratic factors, including declining terms of trade, ongoing labor disputes, and the higher than expected current account deficit in the third quarter. Although to date the current account has been slow to react to the depreciation of the rand, the trade surplus of 0.8 billion recorded in November may signify a possible narrowing of the current account deficit in the fourth quarter of 2013. However, given the volatility of the monthly trade data, it is too early to assess whether or not this is the beginning of a sustainable trend. The extent to which the strikes in the mining sector and resulting decline in exports are likely to impede the current account adjustment further will depend on the duration of the strikes and the extent to which lost output can be compensated for by running down inventories. The economic outlook remains subdued amid continued low business confidence. Growth in the fourth quarter of 2013 is estimated to have recovered somewhat from the low base of 0.7% in the third quarter, and annual growth in 2013 is estimated to have been around 1.9%. Although an improved outcome is forecast for 2014, growth is still expected to remain below estimated potential output of between 3 and 3.5%. The bank's forecasts for growth in 2014 and 2015 have been revised to 2.8 and 3.3% respectively, down from 3% and 3.4% in the previous forecast round. The bank's composite leading business cycle indicator continues to trend sideways and was marginally negative in November. The mining sector is expected to remain under pressure in the face of work stoppages in the major platinum mines, with the risk of these disruptions spreading to the gold mines. Mining output recovered somewhat in the fourth quarter of 2013 from the September lows, and the sector is expected to have made a positive contribution to fourth quarter growth. The manufacturing sector is also expected to have exhibited stronger growth in the final quarter, following the strike-induced contradiction in the third quarter. However, the sector has yet to exhibit a meaningful response to the weaker exchange rate, and the Kagiso PMI declined to just below 50 index points in December for the first time since April 2013. The construction sector represents a mixed picture. The FNB-BR confidence index remained unchanged at 48 index points in the fourth quarter of 2013, the highest level in 5 years. However, the upward trend in the real value of building plans passed observed in the earlier part of 2013 has leveled off, and there was a notable decline in November by 12.5% on a month-on-month basis, and a 14.5% decline on a year-on-year basis. The outlook for civil construction, by contrast, appears to be more favorable. These restrained developments in the real sector have contributed to the slow pace of employment creation in the economy, and continued job losses in the private sector remain a concern. According to the quarterly employment statistics survey of S.Africa, formal sector employment increased by 13,400 in the year to the third quarter of 2013, or by 0.2%. In the third quarter of 2013, employment losses were most pronounced in mining and construction. Growth in consumption expenditure by households moderated from 2.8% in the second quarter to 2.3% in the third quarter, and is expected to remain relatively constrained by disappointing employment growth and a modest rise in credit extension. Slow growth was particularly evident in the consumption of non-durable goods and services. Real expenditure on durable goods remained strong, with growth of 9.3%. Nevertheless, domestic new vehicle sales appear to be under pressure, having contracted by 3.3% on a quarter-to-quarter basis in the final quarter of 2013. Although retail trade sales increased by 1.2% on a month-on-month basis in November 2013, they increased only marginally by 0.1% when the 3 months to November are compared to the previous 3 months. Consumer confidence, as reflected in the FNB-BR Consumer Confidence Index, remained at a low level of -7, a marginal improvement from the previous quarter. Growth in credit extension by the banking system to the private sector continued to lose momentum. 12-month growth in total loans and advances to the private sector moderated to 7.4% in November, with credit extension to households measuring 5.9%, compared with 10.4% at the same time in 2012. 12 months growth in general loans to households, mainly unsecured lending, measured 8.1% in November, the lowest rate of growth since April 2009, while annualized growth over 3 months showed a contraction of 0.8%. Although there has been an increase in commercial mortgage credit extension, growth in outstanding residential mortgages remains subdued at 1.3%. Installment sale credit and leasing finance has continued to be relatively brisk, but could moderate if motor vehicle demand continues to decline. Household debt as a percentage of household disposable income declined slightly from 75.8% in the second quarter to 75.5% in the third quarter of 2013. Wage settlement rates, as measured by Andrew Levy employment publications, measured 7.9% during 2013. However, according to QES data, growth in nominal remuneration per worker declined from 8.8% in the year to the second quarter of 2013 to 6.6% in the year to the third quarter. For the economy as a whole, despite a small decline in labor productivity growth, unit labor cost growth declined over the year from 6.9% in the second quarter to 4.9% in the third quarter. However, there are important sectoral differences. For instance, unit labor cost growth in the manufacturing sector accelerated from 5.6% to 6.9% during the same period, while nominal remuneration per worker in the mining sector increased by 9%. Food prices have been the main contributor to the downside surprises in inflation in the past 2 months, with prices increasing by 3.5% in December. Global food prices generally declined during the year amid improved wheat and maize harvests. The rand exchange rate, coupled with disappointing domestic harvests due to drought in some areas, has impacted adversely on the domestic maize and wheat prices in recent weeks, with the spot prices of maize increasing by about 12% during January, following increases of around 20% between August and December 2013. These pressures have not as yet been observed in the producer price index, where cereal and other crop prices declined by 1% over the year in November. Persistent drought conditions in a number of regions have resulted in the culling of cattle, leading to extremely low meat price inflation since September, and this was at 0.1% in December. However, these favorable food price outcomes are not expected to persist as higher spot grain prices work through to consumer prices. Although the exchange rate pass-through has generally been relatively muted to date, the impact on the petrol price has been almost immediate. International oil prices have been fairly stable, with Brent crude oil trading in a range of between $106 and $109 during January. In December and January, the domestic petrol price was increased by a cumulative 55 cents per litre, and a further significant increase, expected to be in excess of 30 cents per litre, can be expected in February, primarily as a result of the weaker exchange rate. Sustained upside pressure from petrol prices on inflation can therefore be anticipated should the rand continue to depreciate. The MPC carefully considered the economic challenges facing South Africa and the appropriate policy response. On the one hand, inflation forecasts indicate the possibility of being out of the target range for an extended period, largely due to the impact of the depreciating currency. The risks to the inflation forecast are seen to be significantly on the upside. Large adjustments to the exchange rate will inevitably impact on inflation, even in conditions of relatively low pass-through, such as we have been experiencing. On the other hand, the growth outlook remains of concern. Credit extension is low and declining. Few jobs on a net basis are being created, and gross fixed capital formation, particularly from the private sector, is significantly below what is required. Capital outflows and a current account deficit exacerbate the difficulties that lie ahead. Exchange rate pressures are expected to intensify as markets adjust to the new pattern of global capital flows. Although monetary policy in the advanced economies remains accommodative, the process of normalization has begun, and the spillovers have implications for our own monetary policy. The primary responsibility of the bank is to keep inflation under control and ensure that inflation expectations remain well anchored. The depreciation experienced so far could improve our international competitiveness, provided that it is not eroded through higher wage and other input prices. In the light of these circumstances and taking account of policy trade-offs, The MPC has decided to increase the repo rate by 50 basis points to 5.5% per annum as of 30th of January 2014. The MPC is of the view that, notwithstanding this increase in the repo rate, monetary policy remains accommodative. Further moves in the repo rate will be highly data dependent. We will continue to monitor developments closely and will not hesitate to act as required in keeping with our mandate. Thank you.